Welcome to the deep dive. Today we're getting into UK capital gains tax, CGT, for individuals.
Right.
You shared a really comprehensive guide with us, covering, well, everything from what actually triggers CGT to the different reliefs you might be able to get.
Exactly. And look, it's easy to feel a bit swamped by all the detail in CGT, but buried in there is some really valuable stuff, things that can genuinely make a difference to your finances. We're here to sort of help navigate that.
Okay, perfect. Our mission then is to cut through that complexity, pull out the key takeaways, and just make CGT a bit less daunting for everyone listening.
Let's do it.
Okay, let's unpack this. So right off the bat, what exactly is capital gains tax?
Okay, simply put, CGT is a tax on the profit you make, the gain when you sell or dispose of, as HMRC likes to call it.
Right.
An asset that's gone up in value. So that profit is the chargeable gain, and the selling bit, that's the chargeable disposal. Think of it like tax on the increase in value of stuff you own.
Got it. And who pays this? Who's liable?
Generally, well, if you're an individual living in the UK, you're a chargeable person. And UK CGT applies to your assets pretty much worldwide.
Worldwide. Wow. Okay.
Yeah, so investments here, investments abroad, they could all fall under CGT.
You mentioned chargeable disposals. It's not just selling then.
No, that's right. Selling is, the obvious one. But a disposal also includes giving an asset away as a gift.
Oh.
Or if it's lost or destroyed, or even if you get compensation for it, that counts too.
Okay. And what kind of assets are we talking about here? What counts as a chargeable asset?
Well, broadly speaking, almost all forms of property anywhere in the world are chargeable assets, unless they're specifically exempt.
Exemptions. That's where it gets interesting, I bet.
Exactly. And there are actually quite a few exemptions that might surprise people, potentially saving them from an unexpected tax bill.
Okay, let's hear them. What can we sell without worrying about CGT?
Well, for starters, your private car. Sell that. No CGT.
Okay, good start.
Also, any money you've got in national savings and investment certificates, like premium bonds, exempt.
Right.
Same goes for gilt-edged securities. Those are UK government bonds and also qualifying corporate bonds, QCBs.
Okay, so quite a few investment type things. What else?
Investments held inside an ISA, an individual savings account, totally free from CGT.
Always good news about ISS.
And for individuals, money held in foreign currency bank accounts, also not subject to CGT.
That's interesting.
Anymore. Yes, certain chattels. Fancy word for movable possessions.
Right, like furniture.
Exactly. If you sell a chattel for under £6,000, no CGT. Or if it's a wasting asset, something with a limited lifespan, maybe like some antique furniture that degrades, and it hasn't had capital allowances claimed on it, also exempt. Oh, and bravery decorations.
Okay, wow. So my old dining table is fine, but a valuable painting sold for, say, £10,000. That might be chargeable.
Precisely. And just to round out the main exemptions, compensation for personal injury, simple debts, trading stock if you run a business, just plain cash. Shares in venture capital trusts, VCTs, foreign currency you hold as cash for private use, works of art given to the nation, cash from life insurance policies. It's actually, a pretty long list when you look at it.
It really is. Good to know what's not going to trigger it.
Yeah.
So, okay, let's say we do sell something that is chargeable. How do we figure out the taxable gain?
Right. The basic calculation. It's quite logical. You start with the disposal proceeds, what you got for selling it.
Okay.
Then take off any incidental costs of disposal. These are costs directly linked to the sale itself. Think legal fees, advertising, estate agent fees, valuation costs.
Makes sense.
That gives you the net proceeds. From that, you then subtract the allowable costs.
And allowable costs are?
Mainly the original price you paid for the asset, plus any similar costs you had when you first bought it, the incidental costs of acquisition, and importantly, any capital money you spent enhancing the asset's value, like building an extension on a property. Once you've subtracted all those allowable costs from the net proceeds, you're left with either a capital gain, which might trigger CGT, or sometimes a capital loss.
Right, so gain or loss. Now, what about this annual exempt amount, the AEA, and those capital losses? How do they fit in?
Okay. The annual exempt amount, or AEA, for this tax year, 2024-25, it's £3,000. It's basically a tax-free amount of capital gain you can make each year, a bit like the income tax personal allowance, but for gains.
£3,000, okay.
And just like the personal allowance, it's very much a use it or lose it deal each tax year.
Got it. and capital losses if things go down in value.
They can be really useful. First, any losses you make in a tax year, you use them against gains made in the same year.
Okay.
If your losses are bigger than your gains that year, the leftover loss gets carried forward to future years.
Oh, right.
Then, in a later year, if you have gains, you use those brought forward losses to reduce the gain. But crucially, you use them after you've used up that year's annual exempt amount.
Okay, so AEA first, then brought forward losses. That makes sense. Now, the actual tax rates, what are we looking at for 2024-25?
The CGT rates are linked to your overall taxable income for the year. For normal gains, so not residential property, it's 10% if your total taxable income falls within the basic rate band. That's up to £37,700.
And if you're above that,
Then the normal CGT rate is 20%.
okay. But residential property gains are different, aren't they? Higher rates.
Yes, they are higher. For gains on residential property, if you're in the basic rate income band, the CGT rate is 18%.
And above that.
Above the basic rate band, it jumps to 24%.
Right, 18% and 24% for property.
Okay.
Now, is there a specific order for using the AEA and losses, especially with these different rates floating around?
Yes, absolutely. And it's designed to be tax efficient. The rules say you must use your annual exempt amount and any capital losses first against your residential property gains.
Against the higher rated gains first.
Ah!
Smart.
Exactly. Only once those are completely wiped out do you use any remaining ADA or losses against your other normal rate gains. It prioritizes reducing the tax on the gains taxed at 18% or 24%.
That's a really key point. And you also mentioned something about the order of income tax affecting this.
Yeah, just briefly, the final income tax calculation order matters for which CGT rate applies. It goes regular income, then interest, then dividends, then your normal capital gains, and finally, residential property gains are added on top. That order determines how much of your basic rate band is left for the gains.
Okay, good to remember. And the deadline. When do we actually have to pay any CGT we owe?
The main deadline for paying CGT is the 31st of January following the end of the tax year you made the gain in. So for gains in the 24-25 tax year, payment is due by 31st January 2026.
Got it. January 31st after the tax year ends. Let's make this more concrete. You've got some examples for us, right? Starting with Stella.
Yes, Stella. She sold an asset, made a taxable gain of £40,000. Her other taxable income for the year is £20,000. Now, the basic rate income band goes up to £37,700. She's used £20,000 of that with her income.
So she has £17,700 of the basic rate band left.
Exactly. £17,700 available for her gain. So the first £17,700 of her £40,000 taxable gain is taxed at the normal 10% rate. That's £7,770.
Right.
The rest of the gain, which is £22,300, £40K, £17, £7K, pushes her into the higher rate band for CGT purposes, so it's taxed at 20%. That's £4,460.
Okay.
Her total CGT bill is £1,770 plus £4,460, which is £6,230. Shows how income affects the CGT rate.
Definitely. Okay, now cheapo, residential property gain.
Yes. Cheapo sold a residential property, chargeable gain of £40,000. Her taxable income is also £20,000, so she also has that £17,700 of basic rate band left.
Right.
Because it's residential property, the first £17,700 of this taxable gain hits the 18% rate. That's £3,186 tax.
Okay.
The remaining £19,300, £37K, £17, £7K, is taxed at the higher 24% rate. That's £4,632.
So her total is?
£3,186 plus £4,632 popits. Comes to $7,818. You can see it's higher than Stella's because of those residential property rates.
Yeah, clear difference. Okay, Emma's situation. Trading profit and the capital gain.
Right. Emma, scenario 1. Trading profit of £35,600. After her income tax personal allowance, £12,507, her taxable income is £23,030.
Okay, so how much basic rate band is left?
£37,700 minus £23,030 leaves £14,670 of basic rate band available.
Got it.
She also made a taxable capital gain of £15,000. So the first £14,670 of that gain uses up her remaining basic rate band, taxed at 10%. That's £1,467.
Then a little bit left over.
Just £367 plus £66 equals £1,533.
Okay. And the what if for Emma? What if it was a £15,000 chargeable gain, not taxable? How does the AEA change things?
Good question. If the chargeable gain was £15,000, she'd first deduct the £3,000 AEA. That leaves a taxable gain of £12,000.
All right.
We already worked out she had £14,670 of basic rate band left. Her entire £12,000 taxable gain fits within that.
So it's all taxed at the lower rate.
Exactly. £12,000 at 10% is just £1,200 CGT. Shows how that AEA can make a difference, maybe keeping you in the lower band.
Yeah, definitely. Okay, those examples really help. Now, you mentioned earlier something called payment on account, POA, specifically for residential property. What's that about?
Yes, this is a big one for property disposals. It's a specific rule. If you sell residential property and make a gain, you generally have to make a payment on account of the estimated CGT within 60 days of the sale completion.
60 days, that's quite quick.
It is. And it's really important to know this is separate from the payments on account system some self-employed people use for income tax. It's purely for CGT on residential property gains.
So it's like an advance payment just for property CGT.
That's exactly it. And when you calculate this POA, you need to factor in any capital losses you've already made in that tax year up to the point of sale, and also any losses carried forward from previous years.
Okay, so losses can reduce the POA amount.
Yes, they reduce the gain the POA is based on. But remember, this POA is just an estimate, an initial payment. The final definitive calculation of your total CGT for the whole year, including that property gain, still happens on your self-assessment tax return later.
Right, so how do we actually calculate the gain for the POA itself? What steps?
Okay, for the POA calculation, start with the gain on the residential property. Then deduct any current year losses incurred before the property sale date. Then deduct any brought forward losses. And finally, deduct the full annual exempt amount.
Okay.
What's left is the taxable gain for the POA. Apply the 18% or 24% rate to that figure to get your payment on account amount.
And how does that POA then fit in with the final tax bill due in January?
Simple enough. You calculate your total CGT liability for the whole tax year across all gains and losses. The POA you already paid is then just deducted from that total figure. The difference is what you pay by 31st Jan, or maybe what you get back if the POA was too high.
Okay, let's walk through some POA examples to really nail this. Rennie first.
Okay, Rennie, 2,425 tax year. Sells a residential property, makes a £34,300 gain. Also sells an antique table, makes a £20,000 gain. Her taxable income is £28,700. She made a POA of £7,860 for the property.
Right. Let's check her total liability.
First, allocate the £3,000 AEA. Tax efficiently, it goes against the higher rated property gain first. So property gain becomes £31,300 or £34.03K. The table gain stays at £20,000.
Okay. And her basic rate band?
Her £28,700 income uses up part of the £37,700 band, leaving £9,000 available, £37.7K at £28.7K.
Right.
The £20,000 table gain gets taxed first, £9,000 at 10%, £900 tax. The remaining £11,000 at 20%, £2,212 tax.
The total CGT for the year is?
£900 plus £2,200 plus $7,512 equals $10,612.
And she paid £7,860 on account.
Correct. So the final payment due by 31st Jan is $10,612 minus £7,860, which equals £2,752.
The POA worked as a credit.
Perfect sense. Okay, Lana next. Share dealings and a property gain. How does POA work there? Right, Lana. Higher rate taxpayer. In 24-25, April 5K loss, June 28.4K gain, August 9-K residential property gain. Then next March, another 15K loss.
Say busy year. What about the POA after the August property sale?
Take the 9-10K property gain. Deduct losses incurred before August. That was the 5K loss from April. No brought forward losses. Deduct the 3K AEA.
So 19K, 5K, 3K, 3K, 82K.
Exactly. £82,000 taxable gain for the POA calculation. She's a higher rate taxpayer, so that's taxed at 24%. POA is £19,680. Due 60 days after August, so end of October.
Got it. Now the year-end calculation.
Need to factor in all gains and losses. Property gain is 90K. Total losses for the year are 5K plus 15K was 15K plus the 3K AEA.
So 90K, 20K, 3K was 67K taxable property gain?
Yes. At 24% higher rate, that's £16,080 tax on the property gain.
And the share gain?
The share gain was £28,400. Now, the losses and AEA were used against the property gain first because it's higher rated. So the full 28.4K share gain is taxable. As a higher rate taxpayer, that's at 20%, taxes £5,680.
Okay, total CGT liability.
£16,080 property plus £5,680 shares, £21,760.
And she paid £19,680 POA.
Correct. So final payment needed is £21,780. £19,680 equals £2,080. Again, highlights using losses in AEA against the highest rates first.
Definitely. One more POA example. HRTP with brought forward losses.
Okay. HRTP starts with £10K brought forward losses. In 2425, April 35K normal gain, May 6K loss, September 60K residential property gain, January 11K loss, March £5 normal gain.
Right. POA after the September property sale.
Take the 60K property gain, deduct the £10 brought forward loss, deduct the current year loss before September, which was 6K, deduct the 3K AEA.
So 60K, 10K, 6K, 3K, 41K.
Yep, £41,000 taxable gain for the POA. Assuming HRTP is higher rate, that's at 24%. POA, A. Leonard Jan loss, 3K AEA.
So 60K, 10K, 6K, 11K, 3K to 13K AEA. So 60K, 10K, 6K, 11K, 3K plus 30K taxable property gain.
Correct. Normal gains for the year total 35K plus 35K, 40K.
And the tax.
Assuming higher rate. 410K normal gain at 20% equals £8,000 tax. 30K property gain at 24% £7,200 tax.
Total liability.
£8,000 plus £7,200 plus £15,200.
Subtract the POA paid.
£15,200 minus the $9,840 POA leaves a final payment of $5,360. Walks through applying all the losses nicely.
These POA examples are incredibly helpful for that specific rule. Okay, let's shift gears a bit. What about transfers, specifically between spouses or civil partners?
Yes. Transfers between spouses or civil partners living together are treated very favorably. It's on a no gain, no loss basis.
No gain, no loss. What does that actually mean?
It means no chargeable gain or allowable loss pops up at the time of the transfer, so no immediate CGT bill. It's a really key point for couples.
Sounds like a big advantage. How does it work technically?
The person receiving the asset is treated as if they bought it on the same date and for the same original cost as their spouse initially did.
So the history carries over.
Exactly. The potential CGT isn't wiped out, it's just deferred, postponed until the receiving spouse eventually sells or disposes of the asset to someone outside the marriage or partnership.
Can you give us a quick example?
Sure. Andrew bought land in 2010 for £15,000. In 2025, it's worth £90,000. He transfers it to his wife, Rebecca, because they're married and living together. No CGT for Andrew now. Rebecca is treated as having acquired it in 2010 for £15,000.
And if she sells it later?
If she sells it later for, say, £100,000, she then has a gain of £85,000, £115K, subject to her own AEA and the rates at that time.
Okay, so definitely deferral. What if you gift an asset to someone else, maybe your daughter, not a spouse?
Completely different story. That's a really crucial distinction. Gifting to a daughter or any other connected person, like most family members, is treated as if you sold it at its market value on the date of the gift.
Even if no money changes hands?
Even if it's a pure gift, yes. Right. HMRC treats it like a market value sale.
So you could end up with a CGT bill even though you didn't receive anything. That's important to know.
Absolutely. Let's use Andrew's land again. Instead of gifting to Rebecca, he gives it to his daughter Sophie when it's worth £90,000. He bought it for £15,000.
Right.
HMRC sees this as a disposal at £90,000. His gain is £75,000, $90K, $15K. After his £3,000 AEA, he has a taxable gain of £72,000, and he'd owe CGT on that immediately.
Wow, okay. Big difference compared to gifting to a spouse. That no gain, no loss rule for spouses sounds like it opens up tax planning opportunities.
Definitely. Transferring assets between spouses can be a very effective strategy. For instance, if one spouse has, say, unused basic rate income tax ban, or maybe no other gains that year.
Right.
Transferring an asset to them before it's sold could mean the gain gets taxed at their potentially lower rate, maybe 10% or 18%, instead of the 20% or 24% the original owner might have faced.
And potentially use 2 annual exempt amounts.
Exactly. It doubles the available AEA for the couple on that gain, potentially.
Can you walk us through an example of the tax saving?
Okay. Imagine Andrew again. He's a higher rate taxpayer, so faces 20% CGT on normal gains. If he sells an asset with a £75,000 gain, his tax is £15,000, 20% of $75K.
Right.
But what if he first gifts it to Rebecca? Let's say she has no other income or gains that year. She then sells it. Her gain is £75,000. She uses her £3,000 AEA, leaving £72,000 taxable.
And if that $72K falls in her basic rate band,
which it likely would with no other income, she pays CGT at 10%. That's only £7,200 tax.
So the saving is £15,000 minus £7,200.
£7,800.
Precisely. A significant saving just by making that transfer first.
That's very clear. Do you have another case study? Maybe James and Maya?
Yes. James bought land in 2015 for £30,000. In April 2025, he's thinking of selling. It's now worth £55,000. His taxable income is £48,000 higher rate, and he already has other net gains of £15,000 this year.
Okay.
His wife, Maya, has no income and no other gains this year.
Right. So if James sells direct,
His gain on the land is 25,000 pounds, 55K, 30K. Add that to his existing 15K gains, gives 40K total gains. He uses his 3K AEA, leaving 37K taxable gain. And because he's higher rate.
That 37K gain is taxed at 20%. CGT bill is 7,400 pounds.
Ouch, okay. What if he transfers to Maya first?
No gain, no loss on the transfer. Maya inherits the 30K cost basis from 2015. She then sells for 55K. Her gain is 25K.
What?
She uses her own 3K AEA. Taxable gain is 22K.
And she has no other income.
Correct. So that 22K falls entirely in her basic rate band, taxed at 10%. CGT is just 2,200 pounds.
So the saving here is 7,400 pounds minus 2,200 pounds, 5,200 pounds.
Exactly. Another clear example of the benefit in the right circumstances.
Really compelling. Are there any catches, things to watch out for with these spousal transfers?
Yes, one major point. The transfer must be genuine and unconditional. HMRC can challenge transfers that look like they're purely for tax avoidance, especially if the original owner still effectively controls or benefits from the asset. It needs to be a real transfer of ownership.
Very important reminder. Keep it legitimate. Okay, let's move on. What about part disposals? Selling only a bit of an asset.
Right. If you sell just a portion of something you own, you need to work out how much of the original cost relates to the bit you sold. There's a specific formula.
Oh, formula. Okay.
The allowable cost for the part disposed of equals the total original cost of the whole asset, multiplied by a fraction. The fraction is A divided by A plus B.
A divided by A plus B. What are A and B?
A is the amount you got for selling the part, the proceeds. B is the market value of the part you kept at the time you sold the other bit.
Okay. Maybe an example would help. Arnold and his land.
Perfect. Arnold owned land, total cost 120,000 pounds. He sells a section of it for 60,000 pounds. Let's say the remaining land he kept was valued at 250,000 pounds at that time.
Okay, so A is 60K, B is 250K.
Exactly. The allowable cost for the bit sold is 120,000 pounds, total cost, times 60,000 pounds, 60,000 plus 250,000.
Right, 60K over 310K.
Which works out to about 23,226 pounds. That's the cost attributed to the part sold.
So his gain is?
60,000 pounds proceeds minus 23,226 Alice's cost equals 36,774 chargeable gain on the part disposal.
So you're basically allocating the cost based on the value of what was sold versus what was kept. Makes sense.
Precisely. And just quickly on costs, if you had specific costs relating only to the part sold, like legal fees just for that bit, you deduct those directly from the proceeds. Costs relating only to the bit kept aren't relevant for the gain on the sold part. Costs relating to the whole thing, like the original purchase price, use that A plus B formula.
Clear. Okay, what if an asset is damaged, lost, or destroyed? How does CGT work then?
If it's destroyed and you get compensation, like an insurance payout, that's treated as disposal proceeds. But if you use all that compensation money to buy a similar replacement asset within 12 months, you can often defer the gain. It gets rolled into the new asset's cost basis.
Okay, and just damage, not destruction.
If you get compensation for damage, it's usually treated as a part disposal. Unless you use all the money specifically for repairs, then it's generally ignored for CGT.
Right. Okay, that covers physical assets. Let's switch to financial assets, shares and securities. Seems like there are quite a few specific rules here.
Yes, shares and securities definitely have their own set of rules. We need to think about gifting shares, how to identify which shares you sold if you bought them at different times.
Ah, the matching rules.
Exactly. And bonus issues, rights issues, what happens in takeovers, plus some exemptions.
Okay, let's start with gifting quoted shares. Shares listed on a stock exchange. How's that valued?
Right. It's treated as a disposal, but the value used isn't just the closing price. There's a specific method. It's the lower quoted price on the day of the gift, plus half the difference between the higher and lower quotes for that day.
Bit fiddly. Example.
Sure. Share quoted low 400p, high 408p. The value for CGT is 400p plus half of 400p, half of 8p is 4p. So 400p plus 4p plus 404p per share.
Okay.
Your total disposal proceeds are then the number of shares gifted times that 404p. What it actually traded at during the day, any marked bargains, are irrelevant for valuing the gift.
Interesting. Specific formula for gifted shares. Now, those share identification rules or matching rules, crucial if you've bought shares over time, right?
Yeah. Absolutely critical. If you sell some shares in a company and you bought batches at different times and prices, you need rules to say which shares you sold to work out the cost.
So what's the order?
There's a strict matching order for individuals. First, match shares sold with any shares bought on the same day.
Okay, same day acquisitions first.
Second, if you still have shares sold left to match, look at any shares you bought in the 30 days after the sale. Match these on a first-in, first-out FIFO basis.
So shares bought soon after the sale get matched next. That seems counterintuitive.
It does, but that's the rule. Prevents selling, then immediately buying back to crystallize a loss, sometimes called bed and breakfasting. So, match with shares bought up to 30 days after the sale, FIFO.
Okay, same day. Then next 30 days, FIFO. What if there are still sold shares left unmatched?
Then finally, you match those against the share pool. This pool holds all your other shares in that company not caught by the first two rules. The cost is usually averaged out across the pool.
Right, the average cost pool. Can we see this in action? Benazir's example.
Yes. Benazir bought 1,500 shares in May 2022 for $20K, bought 500 more in June 2023 for $10K, then bought 200 more on 15th March 2025 for £4.
Okay.
Now she sells 1,000 shares on 28th February 2025 for $25K. We need the cost of those 1,000 shares.
Right. Rule 1, same-day purchases.
None on 28th Feb. Rule 2, purchases in the 30 days after 28th Feb.
Yes, she bought 200 shares on 15th March. That's within 30 days.
Correct. So the first 200 shares she sold are matched with those bought on 15th March, cost £4,000.
Okay, that leaves 800 shares sold for £1,000 still to match.
Right. Rule 3, match against the share pool. What's in the pool?
The 1,500 from 2022, $20K cost, and the 500 from 2023, $10K cost.
Yes, 2,000 shares total in the pool costs $30,000.
Exactly. Average cost per share in the pool is £30,000, 2,000 shares at Casellas per share.
So the cost of the 800 shares from the pool is £815.
Which is £12,000.
So total cost for the 1,000 shares sold is £4,000 from the March purchase, plus £12,000 from the pool.
£16,000 total cost. Her gain is £25,000. Proceeds minus £16,000, cost £9,000. That really shows how the timing matters. Okay, what about bonus issues? Free shares from the company.
Bonus shares, you get them free in proportion to what you already own. No immediate CGT. They don't have an extra cost.
So what happens?
They just increase the number of shares in your share pool. The original cost you paid is now spread over more shares. That acquisition date is treated as the same as the original shares, so your average cost per share goes down.
Makes sense. Average cost drops. No tax event now. What about rights issues, where you get the right to buy more shares, usually cheaper?
Rights issues are different. If you exercise the right and buy the new shares, they do have a cost, whatever you paid for them.
Okay.
Those new shares, with their cost and acquisition date, just get added into your share pool. So the pool gets bigger in terms of number of shares and total cost.
Right. Expands the pool both ways.
Okay.
Takeovers now. What if the company I own shares in gets taken over?
Yeah, takeovers can happen a few ways with different tax results.
Oh.
A common one is a share-for-share exchange, often called paper-for-paper.
Paper for paper.
You swap your shares in the target company for shares in the acquiring company. If it qualifies, there's generally no CGT at the time of the exchange.
Ah, another deferral.
Yes. The cost you originally paid for your old shares gets rolled over and attached to the new shares you receive, usually split based on the market values of the new shares you get.
So you pay the tax only when you sell the new shares?
Exactly. For example, Cisna has 2,000 shares in Company A, cost £2,000. Company B takes over A. She gets 1,500 ordinary shares in B, worth $3K, and 500 preference shares in B, worth $1K. Total value received, £4.
Okay.
Our original $2K cost is split proportionally. $3K, $4K, $2K equals £1,500 cost goes to the new ordinary shares. $2K, £500 cost goes to the preference shares. Those are her new base costs for future sales.
Got it. What if it's share for cash? You get some shares and some cash.
Then CGT is likely triggered on the cash part immediately. You have to split your original cost between the new shares you received and the cash. Similar idea. Back to Cisna. Original cost $2K. This time she gets 1,500 shares in B, worth $3K, and £1,000 cash. Total value $4K.
Okay.
A portion of the 2K costs. 3K OK. 2K yields £1,500 cost allocated to the new shares. 1K OK equals £500 cost allocated to the cash.
So the gain on the cash is?
Cash received £1,000 minus cost allocated £500 taxable gain right now. The base cost of her new B shares is the £1,500 allocated to them.
Okay, so cash triggers immediate gain. Lastly, on shares exemptions, what securities are CGT free?
Yes, couple of key ones. No CGT on gains from gilt-edged securities UK government bonds.
Right.
Also exempt are qualifying corporate bonds, QCBs. They need to meet criteria like being in sterling.
Yep.
Standard commercial loans, not convertible to shares, and issued on or after 13 March 1984. Gains on these are outside CGT.
Good to know for bond investors. Okay, we've covered a huge amount on calculating CGT. Let's talk reliefs, things that reduce the tax bill.
Exactly. CGT reliefs can either permanently reduce the tax you pay, or allow you to defer it, postpone it. We can think of them as permanent versus deferral, or maybe business versus non-business.
What are the main permanent reliefs? The ones that cut the bill?
Key ones include business asset disposal relief. BADR used to be called entrepreneur's relief.
Ah, yes, B80.
Then there's investor's relief. And for non-business, the big one is principal private residence relief, PPR, plus letting relief.
Okay, and the deferral reliefs.
Yeah.
Postponing the tax.
The main two there are rollover relief and gift holdover relief.
And you mentioned business versus non-business.
Yeah, PPR and letting relief are about your home, so non-business. BADR, investor's relief, rollover, gift holdover, they're generally linked to business assets or investments.
Let's dive into the business ones first. Business asset disposal relief, BADR. What are the conditions?
Okay, BADR gives you a much lower 10% tax rate on qualifying gains. But there's a lifetime limit of £1 million of gains that can get this rate.
£1 million lifetime limit at 10%.
Okay.
What qualifies?
It has to be a disposal of all or part of a business you own, or assets used in a business that stopped trading. If it's shares, you generally need to own at least 5% of the shares and voting rights for at least 2 years before the sale.
Right.
And crucially, you also need to have been an employee or officer, like a director, of that company for those same 2 years.
So really for active owner managers or significant employee shareholders, how does investors' relief differ?
Investors' relief also gives a 10% rate, but has a separate, much higher lifetime limit of £10 million. It's aimed at external investors buying new ordinary shares in unlisted trading companies.
Okay, new shares, unlisted companies.
Yes, and the shares must be held for at least 3 years after 17th March 2016. And the big difference from BADR, the investor cannot be an employee or director while holding the shares.
So BADR for insiders, investors' relief for outsiders. Clear distinction. Let's see, BADR in an example. Mike selling his business.
Okay. Mike, sole trader, sells his whole business since up to 2024, running since 2018. Gains: $260K on goodwill, $370K on freehold office, used in business, $170K on freehold warehouse, owned but never used in business.
Okay.
His taxable income is $8K. He also has $31K of brought forward capital losses.
Right, which gains qualify for BADR.
The goodwill, $260K, and the office, $370K, qualify as they were part of the trading business disposal. Total BADR qualifying gain, £630,000.
And the warehouse.
No BADR for the $170K warehouse gain, as it wasn't used in the business.
Okay. How do we apply the AEA and losses?
Tax efficiently. Use the $3K AEA and the $31K brought forward losses against the gain that doesn't get relief first. So against the warehouse gain.
Right. 170K minus 3K AEA minus 31K losses leaves a 136K taxable gain on the warehouse.
Correct. That 136K is taxed at normal rates. Given his low income, some might be 10%, some 20%. But let's assume for simplicity, it pushes him mostly into 20%. The example shows £27,200 tax on this.
Okay. And the BADR gain?
The 630K qualifying gain is taxed at 10%. That's £63,000 tax.
So Mike's total CGT is?
£27,200 warehouse plus $63,000 BADR gains, illegally £90,200. Using the AEA and losses against the non-BADR gain first was key.
Definitely. Okay, rollover relief next. What's the core idea?
Rollover relief lets you postpone CGT when you sell certain business assets and reinvest the money into new, similar business assets. Deferral again.
What are the conditions to get it?
Key things. Both the old asset sold and the new asset bought must be used in your business. You need to buy the new one within a window, usually 1 year before to 3 years after selling the old one.
Okay.
And importantly, if you don't reinvest all the money you got from the sale, you won't get full relief. The bit you didn't reinvest triggers an immediate gain.
What kind of assets qualify?
Land and buildings used in the business. Fixed plant and machinery. And goodwill, but only for individuals, not companies.
And how does the deferral work? Does it depend on the new asset?
Yes, it does. If you reinvest all the proceeds, the whole gain can be rolled over. If you reinvest less, only part of the gain rolls over. How it rolls over depends if the new asset is depreciating or non-depreciating.
Depreciating versus non-depreciating.
But depreciating asset has an expected life of 60 years or less. Think leasehold property, plant, machinery. Non-depreciating is over 60 years freehold land or buildings.
What's the difference in treatment?
If you roll over into a depreciating asset, the gain isn't taxed now, and it doesn't reduce the new asset's cost. It's held over. It becomes taxable later when you sell the new asset or stop using it for business, or after 10 years, whichever comes first.
Okay, held over for depreciating and non-depreciating.
If you roll into a non-depreciating asset, the rolled over gain reduces the base cost of that new asset for future CGT. So when you eventually sell that asset, your gain will be bigger because the starting cost was lower. Tax is postponed, not eliminated.
Right, build into the future gain. Mrs. Gazebo's example illustrates this. Yes. Mrs. Gazebo sells her freehold office for $80K, makes a gain of £27,950. She buys a new office for $16K.
So she didn't reinvest everything.
No. She got $80K, reinvested $60K. The difference is $20K. So the first $20K of her £27,950 gain is immediately taxable.
Leaving £7,950, £27,950, $20K that can be rolled over.
Exactly. Now, if she buys a leasehold office depreciating, that £7,950 gain is held over, taxable later, based on those trigger events.
Okay.
If she buys a freehold office non-depreciating, its base cost is reduced by the £7,950. So the $60K cost becomes £60,000, £7,950, and £52,050 for future CGT when she sells it.
That clearly shows the depreciating, non-depreciating difference. We also mentioned holdover relief and gift holdover relief.
Right. Standard holdover relief often refers to that gain held over when you roll into a depreciating asset. It crystallizes later. Gift holdover relief is different. It's for gifts of certain business assets.
What assets qualify for gift holdover?
Assets used in the donor's trade. Shares in unquoted trading companies or quoted shares in your personal trading company.
How does it work? The donor, giver, and done, receiver, must jointly elect for the relief. The donor's gain on the gift is then deferred or held over. It reduces the done's base cost for the asset.
So similar to the spousal transfer, the gain carries over to the recipient.
Exactly. When the done eventually sells, they pay CGT on the gain held over, plus any further gain since they received it. There are also rules if the business isn't purely trading, only the trading part qualifies.
Example, Lucas gifting shares.
Yes. Lucas gifts unquoted trading shares to his daughter. They elect for gift holdover. Lucas pays no CGT now. The daughter's base cost for the shares becomes Lucas's original low cost. When she sells, she pays tax on the whole gain since Lucas first bought them.
Okay, it defers the gain onto the recipient. You had a summary table comparing rollover and holdover. Key differences.
Yeah, it basically highlights. Rollover is sell then buy. Holdover, gift, is for gifts. Rollover, non-depreciating, reduces the new asset's cost immediately. Holdover, gift, reduces the recipient's cost. Holdover, depreciating asset rollover, holds the gain separately until a trigger event. Both can be partial. Just help see them side by side.
Useful clarification. Okay, we've done a lot on business reliefs. Let's switch to the non-business ones. Principal, private residence relief, PPR, and letting relief. Big ones for homeowners.
Absolutely. PPR is huge. It can completely wipe out CGT when you sell your main home. Key condition. It must have been your only or main residence throughout the time you owned it for full relief.
What if you didn't live there the whole time? Only partial relief?
Yes, you can still get partial PPR. The exempt gain is calculated, total gain multiplied by months of qualifying occupation, total months of ownership.
What counts as qualifying occupation? Just living there?
Mostly, but not entirely. There are periods of deemed occupation that count even if you weren't physically there.
Oh, like what?
The big one is the final 9 months of ownership. These always count, regardless of why you moved out.
Final 9 months always count.
Yeah.
Okay. What else?
Periods working abroad if you return to live there afterwards. Periods working elsewhere in the UK up to 4 years, again, if you returned. And absences for any reason up to 3 years total, again, only if you return to live there.
So the return condition is key for those absences.
It's very key. Let's look at Olivia. Bought Jan 2006, sold Jan 2025, owned 228 months, lived there, worked abroad, did return, then sold.
Okay.
Her qualifying occupation is actual time living there, plus time working abroad because she returned, plus final 9 months. Let's say that totals 180 months.
Right.
If her gain was £300 K, exempt PPR gain is £300, 180, 228. The rest, 63,158, is chargeable.
Okay. What if you don't return after an absence, like Sophie's example?
Yes. Big difference. Sophie lived there 3 months, went to work in Scotland 4 years, sold 30 years later, 360 months ownership, never returned after Scotland.
So the 4 years in Scotland don't count as deemed occupation?
No, because she didn't return. Her qualifying occupation is only the first 3 months she lived there, plus the final 9 months, total 12 months.
Only 12 months out of 360?
Yes. If her gain was 180K, exempt PPR is only 180K. 12,360 equals £6,000. The remaining £174,000 is chargeable, really shows the importance of returning.
Wow, yeah. What about using part of your home for business, like a home office?
If a part is used exclusively for business, PPR doesn't cover the gain on that part. It's usually apportioned by floor area.
Example, Liam's office.
Liam sells his house. 1 room out of 5 was only ever used as an office. Only 45th, 80% of the gain qualifies for PPR. The 15th, 20% relating to the office is chargeable.
So exclusive business use carves out part of the game. Okay, lastly, letting relief. How does that fit with PPR?
Letting relief is an extra relief, potentially on top of PPR. It applies only if you let out part or all of your home while it was also your main residence.
Ah, so you had to be living there at the same time it was let.
Yes. And the relief is restricted now. It's the lowest of 3 figures. 1, the amount of PPR relief already given. 2, £40,000. 3, the amount of gain specifically made during the letting period.
Okay, lowest of those 3. Naomi's example shows this.
Yes. Naomi sells, total gain, £150K. For part of the time, she let out 25% of the house while living in the other 75%.
Right.
The gain on the 75% she lived in, £112,500, is covered by PPR.
Exempt, leaving £37,500 gain related to the letting, 25% of $150K.
Right. Now for letting relief, we compare. PPR relief given, £112,500, £40,000 limit, and the letting gain, £37,500. The lowest is £37,500.
So letting relief covers the entire letting gain.
In her case, yes, £37,500. Letting relief cancels out the £37,500 letting gain. Result, no chargeable gain at all after both release.
Great example.
Yeah.
So key takeaways on PPR. What should people really remember?
Fundamentally, it must be your main home. Absences matter, especially whether you return. Exclusive business use reduces relief. And keep good records dates. Usage can be vital.
This really has been a proper deep dive into UK capital gains tax. We've gone from the basics, what it is, what's chargeable, right through calculating gains, the AEA, losses, rates, that tricky payment on account for property, transfers, gifts, part disposals, shares, and then all those reliefs, BADR, rollover, PPR.
It's a lot, definitely.
I felt complex starting out, but hopefully pulling out these key bits has made it, more manageable.
Absolutely. Look, the rules are detailed, but understanding these core ideas gives you a really solid foundation. Of course, everyone's situation is different, so this is a starting point for figuring out how it might apply personally.
Right. So maybe a final thought for listeners. Thinking about everything we've covered, the spousal transfers, the business reliefs if they're relevant, the PPR rules, how might you proactively think about managing your assets now to perhaps mitigate CGT down the road? Definitely something to mull over. Thanks for joining us on this deep dive.
My pleasure.
Until the next one.